Getting wealthy versus staying wealthy. Making good decisions is not always necessary for good investing. It's about never making a mistake. There are a million ways to become wealthy, as well as a plethora of books on the subject. But there is only one way to remain wealthy, a mix of frugality and paranoia. And it's a subject we don't talk about enough. Let's start with a quick story about two investors who didn't know each other but whose paths crossed in an unusual way almost a century ago. Jesse Livermore and Abram Germansky. Jesse Livermore was the most successful stock market trader of his time. Born in 1877, he became a professional trader before most people realized it was possible. He was worth $100 million in inflation-adjusted terms by the age of 30. More than a third of the stock market's value was wiped out in an October 1929 week that became known as Black Monday, Black Tuesday, and Black Thursday. Dorothy Livermore, Livermore's wife, feared the worst when her husband returned home on October 29. Suicides by Wall Street speculators were being reported. According to biographer Tom Rubithon, Jesse stood perplexed for a few moments before realizing what was going on. He then informed his family that, by a stroke of genius and good fortune, he had been shorting the market, betting that stocks would fall, and he is fabulously wealthy and can do whatever we want, Jesse explained. Jesse Livermore made more than $3 billion in a single day. During one of the worst periods in the history of the stock market, he became one of the richest men in the world. While Livermore's family reveled in their incredible success, another man wandered the streets of New York in despair. That was Abraham Germansky. Abraham Germansky was a multimillionaire real estate developer who made his fortune during the 1920s. As the economy grew stronger, he did what nearly every other wealthy New Yorker did in the late 1920s, he bet heavily on the soaring stock market. On the day of crash, Mrs. Abraham Germansky of Mount Vernon asked Bernard H. Sandler, attorney at 225 Broadway, to assist her in finding her husband, who has been missing since Thursday morning. Mrs. Germansky told Sandler that a friend saw her husband late Thursday near the stock exchange on Wall Street. Her husband was tearing a strip of ticker tape into pieces and scattering it on the sidewalk as he walked toward Broadway, according to her informant. As far as we know, that was the end of Abraham Germansky. We have a contrast here. Jesse Livermore became one of the world's wealthiest men following the October 1929 stock market crash. It destroyed Abraham Germansky, possibly taking his life. But, 4 years later, the stories collide once more. Livermore, brimming with confidence after his 1929 win, made increasingly large bets. He got in over his head, went into debt, and eventually lost everything in the stock market. He went missing for 2 days in 1933, broke and ashamed. His wife set out to track him down. He returned, but his path had already been determined. Livermore eventually committed suicide. Germansky and Livermore shared a personality trait: they were both very good at getting wealthy and equally bad at staying wealthy. Even if you wouldn't describe yourself as wealthy, the lessons from that observation apply to everyone, regardless of income level. Obtaining wealth is one thing. Keeping it is another matter. If financial success can be summed up in one word, it would be survival. Capitalism is difficult. However, this is due in part to the fact that making money and keeping money are two distinct skills. Obtaining funds necessitates taking risks, being optimistic, and putting oneself out there. However, keeping money necessitates the inverse of taking risks. It necessitates humility and the fear that what you've created can be taken away just as quickly. It necessitates frugality and the acceptance that at least some of what you've achieved is due to chance, and that past success cannot be relied on indefinitely. As a result, survival is once again the most important factor here. This should be the foundation of your strategy, whether it's for investing, your career, or your own business. There are two reasons why a survival mentality is so important when it comes to money. One is self-evident: few gains are so significant that they are worth losing your life for. The other, as explained by the author in Chapter 4, is the counterintuitive math of compounding. Compounding works only if you can give an asset years to grow. It's like planting oak trees. A year of growth will never show much progress, 10 years will make a significant difference, and 50 years will produce something truly extraordinary. However, achieving and maintaining extraordinary growth necessitates enduring all of the unpredictable ups and downs that everyone must endure over time. Now let's attempt to figure out how Buffett achieved his investment returns, and below are few firm traits we can notice. He didn't get carried away with debt. He didn't panic and sell during the 14 recessions he's lived through. He didn't sully his business reputation. He didn't attach himself to one strategy, one worldview, or one passing trend. He didn't rely on others' money. Managing investments through a public company meant investors couldn't withdraw their capital. He didn't burn himself out and quit or retire. He survived. Survival gave him longevity. And longevity, investing consistently from age 10 to at least age 89, is what made compounding work wonders. That single point is what matters most when describing his success. Famous financial thinker Nassim Taleb put it this way: having an edge and surviving are two different things. The first requires the second. You need to avoid ruin at all costs. Applying the survival mindset to the real world comes down to appreciating three things. More than I want big returns, I want to be financially unbreakable. And if I'm unbreakable, I actually think I'll get the biggest returns, because I'll be able to stick around long enough for compounding to work wonders. During a bull market, no one wants to bet on cash. They want to own assets that are rapidly increasing in value. However, if that cash saves you from having to sell your stocks during a bear market, the actual return on that cash could be many multiples of that, because avoiding one desperate, ill-timed stock sale can do more for your lifetime returns than picking dozens of big-time winners. Compounding doesn't rely on earning big returns. Merely good returns sustained uninterrupted for the longest period of time, especially in times of chaos and havoc, will always win. Planning is important, but the most important part of every plan is to plan on the plan not going according to plan. What's the proverb? God laughs at your plan. Financial and investment planning are critical because they tell you whether your current actions are reasonable. However, few plans survive their first encounter with the real world. A plan is only useful if it can withstand the realities of life. And everyone's reality is a future full of unknowns. A good plan does not pretend this isn't true, rather, it embraces it and emphasizes the margin for error. The more specific elements of a plan you require to be true, the more vulnerable your financial situation becomes. Many bets fail not because they were wrong, but because they were mostly right in a situation that required things to be exactly right. However, seldom the room for error is accounted for. Room for error, often called margin of safety, is one of the most underappreciated forces in finance. It comes in many forms: a frugal budget, flexible thinking, and a loose timeline, anything that lets you live happily with a range of outcomes. It's different from being conservative. Conservative is avoiding a certain level of risk. Margin of safety is raising the odds of success at a given level of risk by increasing your chances of survival. Its magic is that the higher your margin of safety, the smaller your edge needs to be to have a favorable outcome. A barbelled personality, optimistic about the future, but paranoid about what will prevent you from getting to the future, is vital. Optimism is commonly defined as the belief that things will turn out well. However, this is insufficient. Sensible optimism is the belief that the odds are in your favor and that things will eventually balance out to a good outcome, even if the interim is filled with misery. And you already know it will be miserable. You can be optimistic about the long-term growth trajectory, but you can also be certain that the road between now and then is littered with landmines and always will be. These two possibilities are not mutually exclusive. It may seem counterintuitive, but many things in life operate this way. Something may benefit in the long term while failing miserably in the near future. Growth amidst loss is a common pattern in economies, markets, and professional lives. For example, the per capita GDP of US grew from $3,000 to little less than $100,000 over the last 170 years. However, do you know what transpired during this time? Where do we start? 9 major conflicts claimed the lives of 1.3 million Americans. Nearly 99.9% of all businesses that were ever founded failed. There have been 4 murders of American presidents. A flu pandemic claimed 675,000 American lives in a single year. At least 400 Americans per disaster were lost in 30 different natural disasters. A total of 33 recessions lasted 48 years. There were 0 forecasts who correctly predicted any of the recessions. At least 102 times since its most recent peak, the stock market has dropped by more than 10%. At least 12 occasions, the value of stocks dropped by 1/3. In 20 different years, inflation was higher than 7% annually. At least 29,000 times in newspapers, the term economic gloom. The American standard of living increased 20-fold in these 170 years, but barely a day went by that lacked tangible reasons for pessimism. It is difficult to maintain a suspicious and optimistic perspective at the same time, since it is easier to see things as black or white than to tolerate complexity. But to survive long enough to take advantage of long-term optimism, you need short-term paranoia. Thanks for watching PLS. Like and subscribe to see more contents like this.